I'm Brian Arcisse, Portfolio Manager on the Global Equity Fund and the International Fund, one of the multi-counselor managers based in Singapore. First, let me apologize for my voice. I would like to pretend usually that it is much better, but it's probably not usually much better anyway. But I hope you can understand what I'm saying. Quite excited to be here for two reasons. One, it's always fantastic to come to South Africa and come to Cape Town. In the past 3 years, I haven't been able to do that. But secondly, there's really been a paradigm shift, particularly in global markets last year, and I think it's a really exciting time to talk about it. As Heather mentioned, in equities and bonds fell last year, each in the 15 to 20% range, and it was the worst year for a standard 60-40 portfolio since the late 1960s. And obviously, many managers, most in fact, haven't managed through a period of accelerating inflation and rising interest rates. And we saw the results of that last year. But it really isn't all doom and gloom. We're actually very excited about the fact that value matters again, valuations matter again, and fundamentals really do matter again. And so we'll chat through that today. There are three things that I want to highlight. One, it's always important to be forward-looking, but given how big a shift there was last year, I think it's important to revisit what the market was telling us at the beginning of last year and how we were positioned. Second, we will chat through our macro outlook for the current year and how we're positioned going forward. And then finally, we'll chat through a couple of investment themes that are prevalent both in the International Fund and in the Global Equity Fund. Maybe just to set the backdrop, this is a chart that William Fraser presented at this meeting last year, not in person, obviously, but over Zoom. And the black line is the Fed funds rate. What I think is most interesting about this chart, really two pieces. But last year at this time, inflation in the US was already 7.5% on a year-over-year basis. Despite that, the Fed funds rate had yet to lift off. It was still only 25 basis points. And you can see the gray line here. Markets were expecting only a 2 or 2.25% sort of peak in Fed funds, and for that to take place over the ensuing 2.5 years, even though inflation was already at 7.5%. The US 2-year at this point was only 20 basis points. Now it's obviously far higher than that, 4.5 plus. So with that as the backdrop, this is William's base case that he labeled Big Bad Wolf. He's far more poetic than me. I usually label them scenario 1, 2, 3. But Big Bad Wolf scenario was our base case last year, which was for the Fed to continue to hike, or to begin, and then to continue to hike quite aggressively to control rising inflation, and that would result in a fall in asset prices. So on the far left, you can see Williams' expectations for about a 20% decline in the S&P, which we did see in mid-year last year, that the US 10-year would end in the 3 to 4% range, which is where it is currently, and that Fed funds would surge ahead of 2.5%. Certainly we were a bit conservative on that one. I think there's still more room to go. But given this, there are a couple of reasons we highlight it. And it's not to highlight the fact that our base case came to fruition, but it's really to highlight the fact that we use scenario analysis in constructing our portfolios. And as I show you our asset allocation that was employed at the beginning of last year, I'll chat through that piece. But importantly, we had two other scenarios, one labeled Cinderella, one labeled Nightmare on Wall Street, again by William. And we really take all of them into account when constructing portfolios. We don't construct for only one scenario. So this was the asset allocation of the International Fund at the beginning of last year, so about this time. Equities made up about half of the portfolio. A significant portion of our equity exposure was hedged, and we were really absent credit. So with expectations of rising interest rates and accelerating inflation, it made quite a lot of sense to us, and we were quite comfortable being very underweight or really absent credit. So it was only 50 basis points of the portfolio. Cash, and then cash created as a result of hedging the portfolio, was about a third of assets, which was also reasonable for us given our expectations for asset values to fall. But I also want to highlight that we do position for all scenarios. And as I mentioned, we aren't constructing for binary outcomes, because a great question can be, if you're expecting equity values to fall by 50%, or by 20%, sorry, why do you have 50% of your asset allocation in equities? And there are really a handful of reasons. One, the equities in this portfolio tend to be more defensive. So these equities fell about half as much as the market. But more importantly, we always have to take into account that we can be wrong. It's very dangerous to position for a single outcome and not recognize that you always need to position for multiple outcomes. Now, last year, obviously, our base case did come to fruition, and this is the performance of the international fund over that period. So, as Heather mentioned, growth of about 2% in absolute dollars, US dollars, against the equity and bonds that fell in that 15 to 20% range. Now, more importantly, chatting about what's going to happen going forward. I can only hope to be so prescient as William. But we do expect inflation and interest rates to still be quite a meaningful determinant of returns in 2023. They were certainly the primary driver of returns last year. They will continue to be this year, but we also have to add into that earnings. So fundamentally as a firm, we really believe the ultimate value of a company is determined by how much it can earn, in particular cash earnings. At the moment, earnings estimates are for growth of plus 3 to 4%, if we use consensus estimates on US markets as an example. And to us, that still seems like it is too high. We have input costs that are continuing to rise and are still very high. We have wages that are still quite high, and though they're bouncing around, are also continuing to increase. And we also have US corporate margins that are at some of the highest levels that they've been at historically. So over the course of globalization, much of that benefit has accrued to the owners of capital and not to labor. We're starting to see that pendulum shift back. So even if we see the percentage of the profit pie shift back to labor by 1 or 2%, which is only about half as much that had shifted to the owners of capital, you'll have a 20% decline in US earnings. Now, we don't expect that in 2023. We're simply highlighting it as a headwind. So on the margin, we think there are many more headwinds than there are tailwinds to earnings estimates. We do continue to think that inflation will remain high. I mean, goods inflation has obviously rolled, which has been received exceptionally well by the market, probably too well. Services inflation, however, really hasn't rolled. And wages in particular, once consistent wage growth is built into a system, is much more difficult to wring out of the system. And that is what needs to happen to have inflation come back to that 2% level. So we don't think that that level is attainable, certainly not in 2023, perhaps not in 2024. But given that, we do expect interest rates to stay high. So the terminal rate either to rise higher than what's currently built into the market, or rise to the level that the market is expecting, around 5.25%, but stay there for much longer. We aren't in our base case building in any rate cuts for the current year. In that environment, however, because rates have already risen to this sort of 4.5 range, we do find short duration investment grade credit now actually quite attractive. And so we do have a position in fixed credit, about 10% of the portfolio relative to the nearly zero that we had in prior years. And despite the fact that we do think that US earnings are likely to roll over, there are regions of the world where you continue to have earnings growth, in particular in Asia. And so that's why we are more constructive on Asian equities than we are on developed market equities, in particular US equities. So Asian equities are still trading about 50 to 60% of the valuation that US equities trade at for better earnings growth. And then finally, we are constructive on gold, not because it's a great hedge against inflation, but rather because it is a good hedge against geopolitical risk and volatility, which we expect both of those to remain relatively high as we move through the year. So given this backdrop, how are we positioned? We have about 65% of the portfolio in equities, and as you look to the right, you can see the regional breakout of that. So less than a third of the portfolio is invested in what we would call expensive US markets, despite those markets representing sort of 55 to 60% of the total global equity pie. So our equity exposure is skewed more towards Asia. We are invested, as I mentioned, in fixed credit. So about 10% of the portfolio is invested in short duration credit, both treasuries and high quality short duration corporates. About 5% of the portfolio is invested in commodities directly, which this 5.5% represents the gold position that I talked about. And about 15% we continue to hold in cash. We do think that there will be plenty of opportunities throughout the year to deploy cash at more attractive valuations than we see today. So we're very happy to sit with that dry powder. Now, there are a couple of themes that I also wanted to touch on within the portfolio, as I mentioned. And one is our materials and commodities exposure. So though I mentioned that 5% of the portfolio is invested in gold, we do have about 15% of the equity portion of the portfolio that is invested in equity-linked commodities. So equities or companies that are active in the commodity complex. So in total, about 20% of the portfolio is invested in commodities or commodity-linked instruments. Now, if you're trying to guard against inflation, over the long term, equities are a good hedge against inflation, particularly equities that own real assets or have real pricing power. But they can be quite volatile during periods of accelerating inflation. Whereas commodities themselves, or commodity-linked equities, tend to offer a better real-time hedge against inflation. The other piece that I would highlight about our commodities exposure is that the materials and commodities equities that are available to us as global investors, that universe is quite broad, and it does differ from the commodities and materials names that are available on the South African equity market. So the majority of our commodities exposure, for example, isn't in miners. But as you can see here, it's quite diversified across the industrial complex, precious metals, as well as agricultural commodities. So on the agricultural side, we're invested in companies that are in the seed space, crop protection space, and fertilizer space. They're also quite inflation hedged. And even in the industrial commodities side, which is typically quite cyclical, one of our larger positions is in a company called Air Products, which is a US-listed industrial gases company. So the company supplies gases to hospitals, to food service, to industries that are actually quite stable. It's raised its dividend for decades, even through the GFC, the prior year of the rat. And it's a very conservative company that also offers a high degree of inflation protection. The other theme that I wanted to highlight and dive a bit deeper into is the Asian equity theme that's active across our portfolios. So about 10 to 12% of the international fund, about 25% of the global equity fund, is invested in Asia, in large part in China. And I just wanted to show you a few slides highlighting why. So if we look at the red bars here, they simply represent the percentage of the global middle class that lives in Asia over these three different time periods. So on the far right, you'll see 2/3 or nearly 70% of the global middle class will live in Asia in only 7 years. And that's up significantly from only 20 years ago when it was less than 1/3. It's not a function of the global middle class shrinking in other parts of the world, though in certain markets it is, but it's more a function of the outsized growth that we see in these Asian economies relative to their developed market peers. So many of the names that we own in the portfolio are positioned well to take advantage of growth in this middle class consumer. And the names on the right here, many of which will be familiar to you, are what we own in that space. I'll highlight two of them that may be less familiar just to give you a sense. But even companies like AIA, which is actually a financial services company, play into growth of a middle-class consumer. The way that they do it, they sell insurance. As people move into the middle class and start generating wealth, they want to buy insurance to not only protect their wealth, protect their health, protect their property. And so insurance penetration tends to rise in lockstep with GDP per capita, which is what we see in many emerging markets, including Eastern Europe, parts of Asia, and in particular in China. And so AIA benefits significantly from that. The other name I would highlight is Trip.com. Most are familiar with Booking.com, so Trip.com is basically the Booking.com of China. It's also a large beneficiary of China reopening to the world, which is what we're seeing now. So the 8th of January, the country fully reopened and now requires no quarantine to enter. So when that was announced, bookings on Trip.com rose 250% day on day from the day before. So the Chinese are like any other markets. There's a big penchant to get back out and travel, both domestically and internationally. And Trip.com is a large beneficiary of that. We're comfortable with the size of our Asian and Chinese exposure, even though if you look at a traditional global equity benchmark, the country only represents 2 to 3% of the most traditional global equity benchmark. And we have, as I mentioned, closer to 20 or 25% on our global equity product. You know, benchmarks aren't necessarily constructed in the most sensible way, and we aren't compelled to invest to a benchmark. But given that, what I wanted to highlight here is that our 20+% invested in China really shouldn't be viewed as a risk. Well, it looks quite outsized relative to a 2% in a global equity benchmark. You have to look at it in context of what does China represent in global GDP. It's already the world's second largest economy, and it's close to 20% of global GDP. So it's sensible to have a far higher weight than 2% to the world's second largest economy and one of the fastest growing in the world. So in our minds, it's doing a disservice to clients to not invest enough in a market simply because it has a low weight in a benchmark. And then finally on fundamentals, on the left-hand side, you'll see over time how Chinese markets have lagged US markets. This is a 10-year chart. You'll see the big run-up in the US, which is primarily US tech, becoming more than a quarter of the S&P, which has now started to come off. You'll see the start of the rebound here in the bottom as Chinese markets reopen. But more importantly, on the right-hand side, so valuations are sort of 50 to 60% less expensive, but what are the fundamentals? What are the earnings? And on the right-hand side, you can see that Chinese earnings are growing 2.5 times as fast as US earnings or developed market earnings, as an example. And if anything, we expect that gap to widen in the relative near term. I mean, I mentioned that we do expect US earnings to come under pressure. And if anything, we would expect Chinese earnings to be revised up as the country continues to reopen. So just to summarize before turning it over to Nancy, the three things that I really want to get across is that if you take all of our views in total, when we do construct portfolios, importantly, we aren't constructing for one outcome. We are intending and construct portfolios to be all-weather portfolios. Secondly, though we do think there will be headwinds to US earnings in particular, there are opportunities in the market, in particular in Asia. But even more broadly, the fact that value, valuation, and fundamentals matter again makes it a fantastic time for investment houses like ours to invest, because we spend much of our time focused entirely on earnings and fundamentals. So with that, I will turn it to Nancy. Thank you.
Thank you so much, Brian. Thanks everybody for coming today. As Heather mentioned, I'm Nancy Hossack and I'm a portfolio manager on the SA Equity Funds. Thank you to Brian. It's been so nice having him here and traveling around the country with him. He's a great guy, a very smart guy. He's also been educating me as to the cost of a decent bottle of wine in Singapore. And I must say I've been feeling a lot more optimistic about South Africa ever since. So it's been great having him. So we've called the South African section today Investing in Times of High Uncertainty. And we're just trying to address what we know is really the elephant in the room. All South Africans at the moment are feeling very, very uncertain about their future. So we're going to set the scene a little bit first. We're just going to talk about how our growth in South Africa has slowed over the last decade. We're going to talk about how we're looking at things going into 2024, and then we're also going to speak about how we deal with those risks from a portfolio management perspective. I'm going to spend a lot of time today talking about growth, this GDP growth function in South Africa. So before you all get very bored, I wanted to explain why I'm going to spend so much time talking about it and why we focus on it so much internally. So this is JSE all-share earnings over time, and you can see there's our SA nominal GDP. And you can see that earnings in South Africa, South African companies are very much tied to what our nominal GDP growth is. I mean, it makes sense. The aggregate South African company cannot grow faster than the economy in general, right? You can get companies growing within that, but as an exchange, we have to look at what that nominal growth is. And that's really the basis that we use to value all of our South African companies, right? It's the terminal growth function that we use. And it's quite interesting when you look at this chart because you can see the earnings cycle around it. We have these peaks and these troughs. That's often what moves share prices. But very much that's the structural growth trend that we need to try and establish. So before we talk about what we think is going to happen going forward, I just want to set the scene a little bit because I think it just gives a little bit more context. So the first chart that I wanted to show you is this is just disposable income. It's real growth, very similar to GDP growth. And essentially what it shows you is we've had these two very distinct periods in South African growth. So post-democracy to 2008, that real disposable income was growing at about 4%. And from 2008 to recent times, that's really slowed. We're seeing this kind of 1.7%, quite an anemic growth rate in South Africa. Now, 1.7% is not so bad. If you compare it to many of the developed markets, they're also growing at similar rates. I think what we need to talk about in terms of that 1.7% is really the fact that we're really missing out on a great opportunity in South Africa and we're underperforming our potential. So what this chart is the previous chart that I've just showed you, but what we've done is we've taken that disposable income and we've divided into population growth and then essentially GDP per capita. So I would say those two things are population growth and wealth increases. That's kind of how we would define it. And you can see we've had this fantastic demographic dividend in South Africa, that very consistent growth of population, about 1.5% per annum. And then you'll see the big increases in wealth we had up until 2008, which are very much stagnated after that period. So actually that 1.7% growth rate, just 0.2% of that has been wealth increases post that 2008 period. It's nice just to compare that to another market. This is the United States in comparison. You can see they've had a much lower demographic dividend than we have, 0.8% consistent population growth, and then very, very consistent wealth increases on the other hand. Just interesting to note with particularly our reference to our US outlook, look at the monstrous increases in disposable income that they had post-COVID. That was government writing checks to consumers. Just worth bearing that in mind when we're talking about the US earnings cycle. I mean, we can talk about many, many different reasons why South African growth has slowed post-2008. I'm one of those people who likes to keep things simple. So this is really, in my view, the primary reason for that. And it's a much longer term chart. It's essentially showing you what our gross fixed capital formation has been, so a fixed investment in the economy, to what our GDP is. And what you can see is that in 2021 and 2022, we've almost never underspent more on our infrastructure than we have in those 2 years. To contrast that from sort of that 1996 up till 2008, you can see that increase in fixed capital investment really drove those wealth increases. It's as simple as the more investment you start putting into economy, the more you get that GDP number going because you're getting wealth increases as a result of it. let's drill down a little bit further. You know, what is the reason we've had no investment? And there's two parts to that story. The most important part of that story, so this is construction spending by sector, and no surprises to those of us sitting in the dark, but that public sector spending in construction has dropped dramatically. So this is actually a nominal rands chart. The previous chart I showed you was a relative chart. This is actually just nominal rand. So in actual rand terms, you can see that our public sector infrastructure spending has almost halved from 2016. If we look at the constituents of what's making up that number, you know, that would include all sorts of things: municipalities, SOEs, and national government spending. And it's not going to surprise any of you with the current load shedding that the SOEs have actually been the major culprit of that underspending. I mean, the private number looks a bit better, I have to say, but if you have a look at this from a real perspective, take out the effects of inflation, or look at it relative to our GDP per capita, the private sector is also really underspending. And that very much follows a business confidence index. So just reflecting the very low business confidence that we're seeing from the private sector in South Africa, not surprisingly because of all the infrastructure challenges that we're currently having. So all of that information is historical. History doesn't move markets, the future moves markets. So we just kind of wanted to outline what our outlook is going forward, and what we're going to make of it from a portfolio construction perspective. So there's no denying that support for the ruling party has waned dramatically in South Africa. We do think that the ANC will likely lose their majority next year. And that really brings us to the subject of coalition politics, minority government, starting to think through the scenarios that might revolve around that. And unfortunately, that means that the array of very long-term outcomes is actually widening. Here's the political support that we're currently seeing. So this gives us this historical political support going back to 2004, national and local government elections. And what this chart doesn't actually show is the dramatic loss of support that the ANC had between 2019 and that 2021 election. So in 2019, the ANC got 10 million votes. In 2021, they got 5 million votes. In 2 years, they lost half of their votership base. Now, it is true that fewer people vote in local government elections, but I can tell you that they got 8 million votes in their previous local government election. So the most important thing going into 2024 is going to be how many of those lost voters will come back to vote for the ANC, or alternatively, how many more of their voter base do they lose. The numbers we put here for national election 2024 is actually not a forecast. It's what we think current support in South Africa is sitting at. And the way we do that is we look at all the by-election data that we see in South Africa. Every 1 to 2 weeks, we get different wards in South Africa voting. And it's actually a fantastic data set, because what it allows us to do is see in real time how voting trends are shifting. And then what we do is we take all of those provincial shifts and we build them up into what we think a national projection is. So this is actually what we think if we had an election today, this is what we think the relative parties would get. So we think the ANC is currently sitting at about 45%. We think the DA peaked in terms of their popularity around about 2016 in that local government election. We think they're around about the 17% level. The EFF continues to tick up. We think they're around 14. Very interestingly, doing very well in the northern part of the country, the northwest and Mpumalanga. They're taking quite a lot of share from the ANC in those jurisdictions, and of course Limpopo is their heartland. And then sort of the unspoken part of South African politics is the resurgence we're seeing in smaller parties. In particular, the IFP, which is taking awards off the ANC left, right and centre in KZN. And then also Action SA is doing quite well in Gauteng. They're taking votes from both the DA and the ANC in Gauteng. Interestingly, entering Limpopo quite recently, I saw there was a by-election yesterday or the day before, got 10% of the vote in that province, so starting to enter into the national network as well. The untold story of the previous chart is just how many people in South Africa don't vote at all. And so you can see in this black line in the local government elections in 2021, I should say, 70% of eligible voters didn't vote. So there's 40 million eligible voters in South Africa. 5 voted for the ANC. I mean, it's quite astounding when you kind of look at it that way. And I guess it's also the opportunity for opposition parties, really. If you can get an opposition party that can start to appeal to this very disenfranchised voter base, there's certainly a lot of opportunity from a political standpoint in South Africa. And unfortunately, none of those opposition parties have really been able to appeal to the voters that are being lost by the ANC over the period. So, 2024. These are the scenarios that we kind of see. My husband always says to me, do you want the good news or the bad news first? And I always say the bad news. So I'm going to start with the bad news first. And what we really mean is, what's the worst outcome for our growth function? What's the worst outcome for markets? And then start to build up to what we think is potentially a better outcome for us. So obviously, the worst outcome from our perspective would be an ANC and an EFF coalition. 2 of those parties have very, very poor corruption records. And obviously, the respect for property rights is a serious, serious problem if you're considering a growth function investment into your economy. Post the December conference coming out of the ANC, we do think the probability of this scenario has decreased. I don't want to say it's an impossibility. It's not. The reason for that is that our president has spent a lot of time within his own party, arguably too much fighting factional battles. But he did come out of that December elective conference with a much bigger majority than he did in 2018 when he was originally elected president. So if we look at the NEC, and the NEC is really the body that holds power between elective conferences in the ANC, they are the body that has the ability to withdraw a president. He had 52% of support of the NEC in 2018 when he was elected, and coming out of the latest conference, he has we think around 67% of the members of the NEC that are in his, what we would call the reform faction within the ANC. So that means within the ANC, they've done quite a lot of work to kind of marginalize the radical economic transformation faction, and we know that that faction is very closely linked to the EFF. And so what we've heard from senior members of the ANC is that they are very concerned about doing a coalition with the EFF because it essentially lets the wolf into the door, and all of this work that you've done in terms of trying to kind of marginalize your opposing faction might be undone by that type of coalition. Not to say it can't happen, it can. We might be wrong. Maybe they don't get 40, they don't fall below 50, you know, maybe they continue to retain a majority. I think if that is the case, South Africans are well experienced with what happens under that scenario. We continue with this kind of low to slightly negative growth. That's not going to be much of a surprise. And then what is the possibility that you might see the ANC doing a coalition with a smaller party? Well, if we're right about the 45%, there's probably only 2 different parties that they could potentially do a coalition with to get them over the 50% mark. That's potentially the IFP. Our data kind of tells us that the IFP is sitting at about 8% of the national vote. Quite incredible considering that they're really only a KZN party. And Action SA, jury's out. They're still quite a regional party. Some of the polls are putting them at between 4 and 5%. So it's possible that they could get enough of the vote to put the ANC up to 50 again. I mean, I guess you guys are just as well qualified as me to make judgments on the probability of this. I think both the IFP and Action SA are really benefiting from a protest vote from the ANC at the moment. And so quite difficult politically for them to make that type of coalition. And then our current base case, which is that the DA, the EFF, and all of these other smaller parties probably don't enter into any formal coalition agreement. We end up with what we call minority government, and everybody votes on everything on an issue-by-issue basis. That's the kind of scenario that we've seen pretty much managing most of the big metros in South Africa. It is very messy, it is very unstable, and again, increases the range of outcomes that could potentially happen in South Africa. And then the one that we sort of think of as as potentially something that could be a bit more of a stable arrangement would be an ANC and a DA coalition. And certainly that would have to be under a very formal coalition arrangement. So we see the DA polling their supporters about whether they would support a coalition within the ANC. And it seems that the answer is coming back from supporters, yes, with very formal conditions. So we think, that might be a lot more of a structured, a more formal, a more stable arrangement. And certainly the DA has a lot more technocratic skills than the ANC does, which they desperately need at the moment. Okay, so talking about all these different scenarios, I always like to kind of visualize things. And so when we're talking about these wealth increases that you can potentially get in an economy if you get high levels of growth, I thought I would just put this up to give you a sense of what those different arrays might look like. So these are the 10 richest African countries by GDP per capita. And what we've done is we've just shown, what does the high road look like? So the top decile of those countries has grown by 3% per annum over that 15-year period. And the bottom decile has lost -3, so a -3% GDP per capita rate. So it just gives you the different range of outcomes that we're starting to kind of analyze in terms of the different scenarios. How does that compare to our kind of more medium-term forecasts? And the IMF's got much smarter economists than I am, for sure. And so if I compare that -3%, that low road scenario, and I have a look at what they've got in terms of their upside base and downside scenarios, quite interesting. They've also got a -3% per capita real output growth as their downside scenario. That translates, if you add population growth into that, to a -1.5% GDP, real GDP rate. And then you can see in their upside scenarios, that starts to look more like 4%. So that's their kind of range of scenarios for how they see South Africa on these different upside and downsides. Now, I know everybody's thinking about load shedding, and you might well say, well, maybe -3% is a good outcome considering the fact that we have no power. This is a chart that actually surprised me. So this is work that was done by the Reserve Bank, and they are basically trying to estimate what is the impact of load shedding on our GDP growth. And in the line chart, as you can see, it gives load shedding hours as a share of total hours. So you can see in 2022, 33% of our hours were being load shed. That compares to 12% in 2021. And the impact that they estimate on our GDP growth, even with the 33% of our hours on load shedding, was only 2% in 2022. So we grew by 2%. We actually grew in a year with all this extreme load shedding. And they're basically saying it would have been 4 if it hadn't been for the load shedding. It kind of struck me. I thought, sure, I actually would have, at the top of my head, I would have thought that it would have been worse than that. There are a few reasons for that. A lot of the load shedding actually happens after working hours. So that has very little impact in terms of our GDP. GDP is really generated by businesses. The second reason is that obviously load shedding is a schedule, so not everybody's being load shed all the time. We know that a lot of the manufacturing producers are also being shielded from load shedding. And thirdly, there are only 3 industries in South Africa that are very affected by load shedding. It's mining, agriculture, and manufacturing. And those 3 combined are actually 22% of our GDP. So South Africa's GDP is probably more tertiary and services orientated than you might think. A lot of those big companies, the banks, the retailers, have already moved on to their own generation and are actually less energy intensive than you might think. So, how do we translate this array of outcomes into valuations? This is essentially what we've done. We've taken that low road number, that -3% per capita real growth number. You add your population growth onto it, gives you about -1.5%. We've rounded up here to -2. And you add your inflation onto the top of it. There we go. It gives you nominal growth in South Africa of about 3%. If we look at South African Inc. companies on the JSE, particularly the ones that we hold, there you can see them first round, the top 5 SA Inc. companies in our equity portfolio. They make roughly a 20% return on equity. And if you look at what is a justified PE with those 2 metrics, you get round about 9 times. And amazingly, when you look at what those shares are currently trading at, they're actually below that number. So what we're trying to say from the scenario analysis is that we think that this very negative growth outlook in South Africa is already well priced into a lot of our shares on the local market. It's worth thinking about the upside potential as well, because you can often get very down and out about things, but you know, look at what happens if we start getting kind of high growth potential in South Africa. You easily double the valuation on those local shares. There's a lot of money to be made if South Africa can start growing again. So, you know, as portfolio managers, we also have to bear that in mind. And then here's just kind of the chart that really demonstrates it. What we've used here is the mid-cap index, mostly because that's really quite a locally orientated SA Inc. type index. And we've compared that to the S&P 500P. I mean, you really see the gap as being this attractive from a relative perspective. Okay, so what do we then do in the portfolios considering this wide array of potential? Well, what we do want to say is that the JSE does provide a lot of optionality inherent in the index, and it's often very misunderstood. So we're going to take you through how that index is actually segmented. And then we've already said we think that evaluations on local equities are pricing in quite dire growth expectations already. And then we're just going to explain how we construct those portfolios to diversify that risk. Okay, so here is the JSE, and what we've used is the CAPI benchmark, because that's our benchmark for the Forward Equity Fund. And all of the stuff that I've just told you about South Africa only affects, really, that 44% of the SA Inc. bucket. Okay, I'm going to demonstrate it to you later. The offshore shares are not really affected about what happens internally. They make up about 31% of that index. And the resource shares are affected by some internal factors. Some of the resource shares listed on our index have really externalized their businesses, don't have very big SA businesses left. So it is affected in some cases by load shedding and all of those sort of things, but actually we put them in a separate bucket because the macro factors have much more of an impact than our internal factors. And then you can just see how we kind of position. So I would say relatively equal weight in terms of SA Inc. relative to our benchmark. We've got a slight increase in terms of our offshore bucket, if I can put it that way. And then you'll see we've got 10% of the fund in cash. That is because of South African uncertainties that we currently see, but it's also because we're worried about global markets and the global outlook. Brian has just spoken about the earnings cycle in the US, and that we are concerned that that earnings cycle is rolling over. If you see big downdrafts in global liquidity, South African shares, no matter how cheap they are, will not go up. So the cash holding that we've got here is actually just as much about our concerns about offshore markets as it is about our internal markets. And then you'll see we have a big resource underweight. Why is that? Firstly, we don't think that 25% in terms of one sectoral that is correlated with each other is a sensible weighting to have in resources. So just because South African index is highly resource heavy doesn't mean we think that's sensible portfolio construction. And then secondly, we think that a lot of these companies, particularly the iron ore companies and the Platts, are very high in their earnings cycle. And so we're quite happy to be underweight many of those businesses. I just promised you that only 45% of that bucket is really indexed to South African growth. Here's the proof. There's the large cap SA index, the mid cap index, which is largely SA in companies. You can see how it fluctuates around our disposable income growth. And then just these two very different buckets, the offshore stocks obviously being big outperformers on our local market. And then the resource stocks actually been really big underperformers, but in recent times had quite a rally. On the fixed interest side, we still think that SA bonds continue to offer quite a bit of value. You can see here, this is the real yield on our 5-year government bonds. We are worried about the balance sheet of our fiscus, and so we tend to stay quite conservatively positioned in terms of duration on that yield curve. Here's the balanced fund, just our positioning, I would say, not a lot has changed in terms of our local positioning. We still maintain quite a decent equity holding at about 68% of the balanced fund. And what we have done, similar to what we've done in our equity fund, is increased our cash holdings. You'll see that in the kind of SA money market portion, again with similar concerns about kind of global uncertainties and also potentially with SA uncertainties, just looking for keeping some money on hand in case we get some better opportunities. I wanted to end on an optimistic note because I think that, you know, in all the doom and gloom, you can sometimes kind of, you know, when things have been trending in a certain direction, it's always important to look for inflection points. It's one of the big lessons that I've learned doing this job, is that sometimes you're patting on yourself on the back because you've got something right. In this instance, we've been underweight construction companies for a long time, and it's been the right call, as I've just showed you, because construction spending in South Africa is extremely low. But it's always important to make sure that you're not going to see something turn around. If your base starts to get very low, actually, if spending picks up, you get very, very high growth. And so this is something that we've been adding to the portfolios a bit. This is WBHO. When we looked at all the construction stats, we started to think, okay, well, you know, where does this bottom out? And then we started thinking about what all the mines are doing in South Africa. So there is about 100 billion rand in spend and 89 different projects coming from the mines in South Africa in terms of generating their own electricity. Okay, so it's a massive pipeline. We spent some time speaking to the Minerals Council of South Africa. They have seconded their energy expert to the presidency in order to get all of these projects passed, to remove all of the red tape, to make sure that they're approved, to make sure that they have the transmission networks in order to connect into the grid. So we know that there's a very, very big spend coming. It's a no-brainer for them. They pay it back in 5 years, and essentially the mines are 30% of South Africa's energy demand. So being able to take themselves off the grid also allows for a lot more capacity for other consumers in the energy space. So interestingly, when we looked to say, well, maybe now is the time to start looking at construction companies, it's not that easy to find construction companies anymore on the JSE. Most of them have externalized their businesses completely because they've been dealing with this very, very tight market. So interestingly, this is the market share of WBHO. In terms of large construction, they're almost one of the only guys left standing. I think Raubex is probably the other one on the exchange that has a relatively big South African business. This business had a very hard time in Australia. They let that part of their business go. So they're very South Africa and Africa focused going forward. And actually, when you kind of look through all the mess of deconsolidations and you know, segments, you start seeing that actually the order book in South Africa is starting to fill up. And there's the proof, there's the order book that we've actually put in. That's actually contracted work, right? So we're starting to see what we think is a bit of an inflection point in construction here. We certainly think there's going to be a big energy build in South Africa coming, because it's really being privatized, right? We're not relying on Eskom to do it. So I think with that, you know, we're always aware of the risks in South Africa. We do think we're into another uncertain environment. We can't quite tell you which way this is going to go, but we do still feel very happy as portfolio managers that we have quite a lot of optionality on our local exchange. Even in the SA equity funds, we've got quite a lot of opportunity. In the balanced funds, we've got a lot of opportunity. And yeah, I think with that, I'm going to hand over to Heather.